Hello, welcome back. Today we're going to be taking a look at Bed Bath & Beyond. The company seems to be trending higher today at about 36% right now. And as usual, we're going to be examining the financials and also create a discounted cash flow model just to see what kind of price we should be willing to pay for the company if we decided to buy it. And we're going to use our exclusive tool to calculate that. But first things first, welcome aboard if you're new here. And if you aren't new, welcome again. I hope you enjoy the content and please leave a like because that really helps the channel and helps bring this content to more people. And again, if you are new around, you may want to consider subscribing. I'm creating tons of content, so some of which may be useful for your investing. So, the outstanding shares of the company is the first thing that we want to examine here. And you see that's going down. The company has announced some buybacks years ago, and they are continuing to do that, which is nice to see. So this is a very, very good thing for investors, really. But the next thing that we want to see is that the company is down at 23% in the last year. So that's something that we should be noting from the chart as well. In total, it must be way more, right? Yeah, from 2015, it's basically in a downwards trend that doesn't seem to be stopping. There was a little bit of an uptrend over here, but then went back down again. And we're gonna take a look at the income statement of the company. Now, I kind of wanted to potentially use my tool here for showing you the revenues and all the income statement and balance sheet and cash flow and all that. And I think I'm going to do that just because it makes a little bit more sense to see something here in terms of how the net income is actually shrinking and the free cash flow is growing, and we're gonna be using the tool to easily understand why here. I think it's an easier way to see what's happening, the way these things are presented here. So the first thing that you see here is that the revenues are kind of declining here. In 2021 they were down 17% from 2020. So this is the first thing to check here. And of course you can see a full breakdown of what's been happening with the company. But the other thing that you want to see here is that their net income, as you see, is decreasing. And so from 600 million to minus 150 here. So they seem to be losing money really from operations. And now I wanted to quickly take you to the cash flow statement before we jump to the balance sheet. Because remember that their net income, and you can see it here, has been shrinking, and you'll see that it is negative here. Yet their free cash flow over here is positive, and you'd be wondering why that's happening. So there is a couple of things why this is happening really, but the most important thing is depreciation and amortization, which is added back to the cash flow really, and this is why it kind of skews it upwards. So you are not really seeing the company enjoying cash from operations, but it's basically the depreciation and amortization aspect of the company that's enhancing the free cash flow, and you can actually see it here. And there is also a little bit of stock-based compensation and things of that sort. But in terms of the net income of the company, which comes from operations, it's actually negative. And so this is something that you need to bear in mind when you are looking at the free cash flow of this company, because it is skewed due to depreciation and amortization here. The balance sheet over here at the company, for the company, is showing that their total current assets are actually the same in 2021 than that they were in 2017 really. And the total current liabilities here, which I want to see, the total current liabilities are sitting at 2.3 billion, and the non-current liabilities at 2.9 billion. So the company has about 5 billion in terms of liabilities really, and you can see it here, 5.18 billion in terms of total liabilities, and their total assets are 6.4, bringing their total equity to 1.2 billion over here for the company. And the free cash flow statement is what we examined a little bit earlier, the cash flow statement. And you will see here that, as we said, the net cash from operating activities is positive, and we examined why. But the cash from investing activities is slightly positive over here, and that's because of some acquisitions that they made and some sale of maturity. So they sold some investments here, and in 2020 and 19 also sold some stuff. And The next thing is the net cash provided by financing activities. And you will see here that the company is actually not really adding more debt. It seems like they are paying some debt back, so you see some debt repayment here, which is good to see. And they are repurchasing common stock, which is something that we already saw. And the free cash flow, again, it's in the positive. Now, I want to use my stock evaluation tool here, and you will see that I have a very handy table here that kind of shows me the information that we examined earlier, showing me the declining revenues, the declining net income year-over-year growth over here, for example, or the net income margins, and pretty much everything about the free cash flow. And I have a very handy also averages table here that I can use for my projections. And the way this works is we're having low, medium, and high projections, meaning that we are a little bit cautious over here for the low ones. This is like our average estimates, and over here we're getting the optimistic ones. Now you will see that the revenue growth is minus 5% for the 5 years, for the last 5 years on average, and 9% for the last 3 years, and 17% last year. So it seems to be declining more and more every year, really. Now I'm gonna be a little bit, I guess, confident, more optimistic, because otherwise I'm gonna be getting terrible numbers here for the company, really. So I think I'm gonna go 0, 1, and 2. I'm gonna create a scenario in which the company doesn't really grow its revenues, but at least it's staying at the same level. And we're talking about this level, right? The last one over here. So $9.23 billion being our starting point over here. And the net income margin, as you can see here, is about 0, 1, 2, something of that sort. It's very, very small. So I'm gonna go 1, 2, and 3 here. And the free cash flow margin, you'll see it's very negative here, but that's because of the last 3 years, and especially 2019. The company had the net income loss, and this is why that happened. But in the previous year, it used to be at around 100. I'm gonna go somewhere around the middle, like 40, 50, and 60% for my projections here. And my annual return is what I want to be making from my investment, which is going to be 13% here. I'm gonna use calculate, and this comes back with $5 for the price of the stock today to buy it. I mean, that's the max price to pay today to enjoy this kind of numbers here. The medium one's 13.30 and the high one's 25, which is the only one that is actually more than the current price. And so only for our high estimates here, it makes sense to be buying Bed Bath & Beyond if we're using this model. Now again, this may be a little bit too optimistic, and if we change the numbers to something that is way less optimistic than this, let's just say that the company is going to go minus 10, for example, over here, it's going to be much worse, as you can expect. And let's examine that. Let's actually do that from scratch. I refresh the page. So the revenue growth that we are going to go for in the low estimates is going to be minus 5%, which is the 5-year average. We're going to say that this is going to be our worst case situation here. Then minus 3%, and let's just go high 1%. And the net income margin, we're going to go the same, 1, 2, 3. I think that makes sense. The free cash flow margin, again, this we don't really want to go too low. We're going to go 10, 20, and 30, which is still rather low. And you need to remember that these years we're sitting at about 100, and this is about the correct one if if things are normal with the company's net income and the company starts making money. It's again the fact that they are making the free cash flow from depreciation and amortization for the most part in these last few years, and this is why it's very, very useful to include net income in discounted cash flow calculations, because you see what kind of free cash flow comes from profitability, from actual profitability, and not from depreciation or stock-based compensation and things of that sort. Very important, and this is why we're using this metric in this model. And so if we calculate now, again, you will see that we're getting much lower values as expected, like $1 is in the low ones, 4.45 is the medium, and 12 is the high, with the current price sitting at 20.47. So what I'm seeing from this company is declining revenues, really declining net income, profit, pretty much. And I wouldn't say that I'm very, very confident about how the company is going to be doing, even though it's up today. So I would definitely be cautious about adding it to my portfolio. and it doesn't seem to be meeting my expectations here. And the fact that their free cash flow doesn't come from profitability and it's basically from depreciation and amortization and things of that sort, it's not my best thing. I'd like to see the company going back to very, very positive net incomes like this a couple of years before I decide to invest back in it. And that doesn't seem to be the case. And I don't know what's going to be happening after the pandemic resides completely. So I still want to give it a little bit of time to see how that will work over the years. Hope that makes sense and hope you enjoyed the video. And if you did like this one, please leave a like because that really helps, as I mentioned earlier. And in case you did enjoy this video, you may want to take a look at this one that I made earlier about Alibaba, and I'm examining how much it would be interesting and useful for an investor to pay for the company based on what they're doing financially. Thanks for watching this one, and I'll see you soon. Bye bye.